Hello traders, welcome to the first video of 2025. In this year, we are going to explore several trading strategies and I myself will help you as much as I can. In this video, I'm going to give you the first strategy that you can utilize and can be used on several assets including gold, US oil, US 100, currencies, any tradable asset that you can think of. It's going to be utilizing two time frames, which is the H4 time frame and the H1 time frame. On the H4 time frame, you utilize the Traders Dynamic Index, which is a free indicator that I'll provide you for free. Just say hi using the Telegram link that I'll leave in the description box below. The other time frame that you'll be focusing on will be H1 time frame, where you'll be looking for a pattern. So it's something that will require you to synchronize these two time frames so that you get the proper entry point. The take profit and the stop loss I will show you when we jump over the charts. But above all, you need to be a good risk manager for you to make it using this particular trading strategy. Without further ado, let's jump right over the charts. Alright, so we are going to use US against oil, which is a less frequently traded asset by several traders. And why oil? It is because I've said earlier that this particular strategy will work on any tradable instrument. So it might be an index, it might be a metal, it might be a commodity. You will follow the same rules that I'll share with you. But before we start, I'll emphasize that in 2025, be a good risk manager. Try to be professional. Leave those trades that you used to do when you were in the previous years. This year must be your year. You should see something tangible out of this business. Without wasting much of your time, let's jump over the charts. All right, so this is US oil. The first time frame that we need to look at is the H4 time frame. We can see that the H4 time frame is actually a very huge time frame. It's a time frame that I call the weekly time frame due to the fact that when we switch to the H4 time frame, these period separators will mark periods equivalent to weeks, right? So when we have weeks on our charts, we need to actually find the high and the low of those particular weeks. So the strategy in summary is basically to trade from the high and low of a week. When we find the high or low of a week, that is where we look to get our entries. So how do we get the highs and lows of weeks? It's not difficult because we are going to utilize the Traders Dynamic Index, which is an indicator that utilizes market sentiment as well as momentum and volatility. So on the Traders Dynamic Index, we have these blue lines, which are volatility bands, and the one in green, which is the RSI line, the one in red, the signal line, and the moving 50. But we are interested in the RSI line, which is the green one, and mostly with this blue volatility bands. So the definition or the first step that we need to take before doing anything is we will be monitoring our markets on H4 time frame. H4 time frame, we know that we monitor 6 times per day, whereby we have 6 candles each and every day. So at every 4 o'clock, 4-hour interval, you need to check the charts to see if you find what we call the shark fin. The shark fin is basically an explosion or a piercing out of the RSI line outside these two blue bands. So when this happens, it's now time to check the other parameters. So the H4 time frame is basically to give you this shark fin, and after that shark fin has been issued, the next thing is now to go on the H1 time frame. So if we go on the H1 time frame, what we'll be now looking is to confirm if exactly the point that we have been issued or given is actually the weekly high or weekly low. How do we determine that? Shark fin has been seen, and then we now go to the H1 time frame. On the H1 time frame, we need to see a peak that is a result of 3 days of rise or 3 days of drop. So if we check on the H4 time frame, this was a shark fin point where we've seen together we can see that we had a pierce out of the RSI line to the upside, which is at this particular point here. And we had another piercing here on the H4 time frame, TDI, and then here. So we are going to look for these points on the H1 time frame to confirm what I've just said. On the H1 time frame, what we want is an M or W pattern that is a result of 3 days of rise or 3 days of drop. Like in this particular case, we can see that we had from this low, there was day 1 of rise. Then we had day 2 with the pullback here, day 2 of rise. And then we had day 3 of rise. There should be at least 3 days of rise to reach the point that we have determined using the H4 time frame. In this particular instance, we can now see that there is an M pattern, first leg and second leg. Of course, you can improve the presentation of this M pattern by using the high, yesterday's high or low day marker, which actually shows you that this first leg has been issued and then this second leg has been issued. So this was actually a very good point of entry after a candle closure on the H1 time frame below the 13, meaning we could actually get in and exit at the 200 EMA. For the purposes of those who do not understand the EMAs, these are 5, 13, 50, 200, and 800. Moving forward, we can see that if you do not understand levels counting, be sure to be part of our top 1% masterclass, where I will teach you exactly how to count these levels non-subjectively. So this is level 1, this is level 2 or day 2 of drop, and then day 3 of drop was issued here. On the third day, we can see there was a W pattern that was issued. So this W pattern is actually to show you that, or to confirm the shark fin that you've seen on the H4 time frame. Therefore, this was a good point of entry. At candle closure above the 13, which is here, that is where you would make your entry, right? From there, we start again. We've marked this point from the H4 time frame, TDI shark fin. So we had the first one, rise, first day of rise, second day of rise. I've said these levels, I can teach you how to draw them correctly. Just be part of the top 1% masterclass. So here we had small m that was issued, and our exits should be on the home baseline. What is the home baseline? The 200 EMA is the home baseline. So in this case, this was an entry. Your exit was going to be on the home baseline. In this case, your entry was here and your exit was on the home baseline. And then here you had a drop and exit at the home baseline. So basically that is what you'll be looking for. You need to see H4 shark fin, H1 M pattern. That is a result of 3 days of rise or 3 days of drop. There should be at least 3 days of rise or 3 days of drop. Do not just take any M that will be issued maybe after 1 day of rise. We need an M that is a result of 3 days of rise or 3 days of drop. Then after that, your entry at candle closure below the 13, stop loss above the price or above structure, and take profit at the home baseline, which is the 200 EMA. Basically like that. If you do so with enough discipline, you will make money out of this particular strategy. It's not 100%, of course, but we are saying much of the times you will be on the right side. On that note, we've come to the end of this video. Thank you for watching. Like and subscribe, and I'll see you in the next one.